Welcome to GRE. I'm your host, Keith Weinhold. Apartment building values have crashed about 30% in the past few years. Well, it's the opinion of today's qualified guest that it's going to get even worse from here. We'll also discuss why rents in the Phoenix area are declining and a bold prediction on a collapse in the homeownership rate and the hordes of renters that will create, all today on Get Rich Education. Mid-South homebuyers, they're total pros. With over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your ROI as their North Star, so it's no wonder that smart investors just keep lining up to get their completely renovated income properties like it's the newest iPhone. They're headquartered in Memphis and have globally attractive cash flows, an A-plus rating with the Better Business Bureau, and now over 5,000 houses renovated. There's zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate, while their average renter stays more than 3.5 years. Every home they offer has brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and, wait for it, a high-quality renter. Remember that part? And in an astounding price range, $100 to $180K. I've personally toured their office and their properties in person in Memphis. Get to know Mid-South. Enjoy cash flow from day one. Start yourself right now at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from the Tigris to the Euphrates to the Mississippi, and across 188 nations worldwide. I'm Keith Weinhold, GRE founder, Forbes Real Estate Council member, best-selling author. Look for my work in the USA Today as well, and you are back inside for another wealth-building week of Get Rich Education. What's all that really mean? I'm just another slack-jawed mouth breather with a mic here. Before we get to today's guest, Ken McElroy, let me tell you about housing's new power shift and where we're at today. 3 to 5 years ago, sellers held all the power in virtually every market because the housing supply was so miserably low everywhere. So you had more wanters of real estate and few that were willing to sell. That is still mostly true on a national level. But the new power shift is about the fact that the Northeast and Midwest are replete with home buyers. Queues of buyers are lining up for the few available properties, like I've touched on before. And look, low available housing supply in these areas, the Midwest and Northeast, that's not a symptom of mass in-migration. Hordes of people are not stampeding into Buffalo for the nightlife. It's all due to chronic underbuilding, partly from strict regulation, especially in the Northeast. A big part of the power shift, though, is that we now have fully 10 states that are above pre-pandemic supply levels, and you'll notice that none of these are in the Midwest and Northeast. The 10 states are Arizona, which we'll talk about more today, Colorado, Florida, Idaho, Hawaii, Oregon, Tennessee, Texas, Utah, and Washington. Here in these places is where the tables have turned because supply is catching up with demand in those 10 states. So that's where we're seeing softer home price growth. And where buyers have the power, these are some of the states where you can find better deals. Motivated sellers and builders in these places will often buy down your mortgage rate, give you closing cost credits, or reward you with incentives like a free year of property management. In fact, our GRE Investment Coaches guide you for free to exact property addresses where builders will buy down your mortgage rate to 5% today. One of them will even give you a $9,800 post-close credit instead, if you so choose. Often, Deals like that are in those 10 states. They're elsewhere too. You can get started at greinvestmentcoach.com. Conversely, 40 states have less for sale housing inventory than they did as compared to pre-pandemic times. This is where sellers still have the power. Some of the most competitive markets in the nation are Buffalo, Hartford, Providence, and Boston, where more than 10 active home buyers vie for every single listing. That's per Zillow. Yeah, that's sort of the real estate equivalent of a Taylor Swift or Beyonce ticket queue. At the other end of the spectrum, shoppers have an easier time in Miami with only 2.6 shoppers per listing, followed by Houston at 3.4, New Orleans at 3.5, and San Antonio at 4.3. Nationally, active listings are up 31% over last year. That's quite a bit, but we're still 12% below pre-pandemic 2019 inventory levels. And is all this good news or bad news? It totally depends on who you are. If you're holding property in the Northeast and Midwest, you're pretty happy about this strong appreciation in the single-family space. But in the Southeast, appreciation is non-existent, or there's even mild depreciation, especially in parts of Florida. If you're looking to own more property in the nation's southeast quadrant, you're now enjoying less buyer competition. In fact, sellers are competing for you. And let's avoid being too assuming here. I've been talking about things on the state level. States are not monoliths. Philadelphia is not Pittsburgh. Seattle is not Yakima. Cities have different supply situations. Even within one city, the scenario varies, of course. Really, the bottom line here is that today's recovery from 2022's national supply abyss has been an uneven recovery. Where builders are frozen, appreciation soars. Where builders hustle, buyers win. So if you're looking for deals, find that short queue. Today's guest is a familiar one to GRE listeners. He's based in Scottsdale, Arizona, which is the Phoenix metro. Arizona, though it's fast-growing, is still just the 14th most populous state. But Arizona is an interesting market because we're going to get to see what happens when you have an overbuilt condition like we do there. We'll discuss that market and the national market as well. Get a key gauge on the direction of rents, occupancy, and prices, first in the single-family space, and then we'll talk about apartments. Anyone that's paid attention to real estate the past few years knows that when mortgage rates spiked in 2022, single-family values have held up, apartment values plummeted due to their interest rate resets. We'll get insight on if the beleaguered apartment space has bottomed out price-wise or if apartment values still have further to fall. I'd like to welcome in frequent GRE guest, and he was also one of our earliest back in 2015, Ken McElroy. Ken authored a bunch of successful books, both within and outside of the Rich Dad series. He's also a well-known, successful apartment syndicator with over 10,000 units across several states. And he's also in other parts of the commercial real estate sector, including billboards and self-storage. So it's really great to have back on the show, Ken McElroy.
Good to be here, Keith. Thank you. It's been 10 years, man, since we've been doing this.
Yes, 10 years, back at episode 25, since you were first here. More than a decade of this, so we know each other's work really well, and it's such an interesting time in the apartment space. I want to get to that later in our conversation today and really find out if you think that the apartment space has bottomed out. But before we do that, let's talk about the single-family space. The audience should know that you can meet both Ken and I in person, as we're both faculty members on the spectacular Real Estate Guys Investor Summit at Sea, which is actually underway now. We're recording this just before the summit. So let's discuss the direction of rents and occupancy. We'll get to price later. And Ken, although most states still have a housing shortage, statewide, Arizona's active housing inventory for sale is 24% rent above pre-pandemic levels. That's what Realtor.com tells us. And that's chiefly due to a lot of building. A lot of building usually does not bode well for price growth or rent growth. So tell us about rent direction and occupancy in the single-family space in the Phoenix metro.
There's a bunch of things happening in the Arizona market. First of all, one is we've had a lot of people move here, right? In the last 4, 5, 6 years.
Yeah.
Pre-pandemic, post-pandemic, all of that. We are a pretty small state. You got Phoenix, you got Tucson, you got Flagstaff, and then a bunch of other small cities that kind of surround some of those. But it's not like a Texas or a Washington or a lot of these California, like a lot of states that have a lot of cities to draw from. If people move to Phoenix, that's pretty much where they start a lot of times, not every time, and so it's really interesting when we have net in migration into Arizona, it really moves the needle for most of these cities is kind of the point. And so we're always going to be affordable. We're always going to have great weather. It's safe. We got pretty normal politics, I should say, as compared to some of the others. We really do have a growing population. And so what happened? We had a nice run on the real estate, as you do. You know, we had a nice run on the apartments. We had a nice run on the single family. That tapered off when the interest rates went up, essentially, right? You know, we actually built too much. We built too many apartments. We built too many houses. When interest rates went up, people kind of pulled back. That's what you're seeing now. So right now, it's a great time be a home buyer. It's a great time to be a renter in most of those cities in Arizona specifically. And why would that be? It's because they have a lot of choices. So on the single family side, the listings have gone up and therefore some of the prices have, people are starting to negotiate a little bit more. Now, here's the interesting thing, Keith. If you measure it on last year or the year before, it has huge numbers like you just quoted, 24%. But what's happening is things are on the market like 40 days, you know what I mean? Like from a week or two, it's doubled or tripled. As you know, that's still not a very realistic market. The market is still, in my opinion, pretty healthy. It's not unbalanced. And before it was a seller's market. And so it's just normalizing. And normalizing to me, if you go over year, is I think MLS says 4 to 6 months of inventory, right? I think things are just normalizing. But if you've been through the run, this is like the end of the world, right? But it's not. It's just things are settling down. And it's the greatest time because there's supposed to be a little bit of friction between the seller and the buyer. I believe there should be just about right. It's never just right, as you know. It's usually pulls on harder on one side or the other. But we just went through an incredible time where the sellers pretty much got whatever they wanted. And the landlords pretty much got whatever they wanted. And so this is just pulling back. The tide's going back out. There's no cause for concern, at least in my world, at all. It's supposed to be this way. And we need affordability. We need people to be able to buy homes. We need people to be able to rent. Yeah, I'm in the landlord business, but I don't want rents to run. There needs to be a balance there, even though it's good for me if it does. But it's not good because what happens is then the government gets involved. And what they need to get involved in is adding supply.
Right.
And not capping the rents. What they need to do is just work with developers and, because we're growing here in Arizona. Right now we're seeing a pullback, but I think it's needed. There's nothing wrong with this. It weeds out a lot of, realtors that weren't doing much, that just got their license, were hanging around, say with mortgage folks and title people and lazy contractors and all that stuff. So whenever there's a pullback, the professionals win.
Well, this is some really good perspective here. We're all victims of the recency bias. And yeah, you're talking largely about market normalization. What sure wasn't normal or healthy in a lot of ways was back in 2021 when you might have had 50 offers for one available property and people had to bid $50K over the asking price and they might have waived their inspection, which is typically not a good idea. When we talk about rents and the direction of rents, especially there in the Phoenix metro, with single family homes, which I know your wife, Danielle, is pretty intimately involved with, typically this new supply increases competition. It increases the competition for landlords competing for more of those tenants, which is something that typically is not good for rents. Have we seen declining rents in the local market there in Phoenix?
Of course, yeah. And I'll tell you, there's a bunch of factors. So there's always cross currents. People want one answer, but there's not, right? Like, so let's just pick on a whole bunch of things that went wrong. At the tail end of all of this, it was Airbnb. Like Phoenix and Scottsdale are a huge Airbnb market. Like
I've rented Airbnbs there, sure.
it's incredible, right? And so what happened was a lot of people said, "Oh, I can buy this house, throw some furniture in it, and I can get 10, 15, 20 grand a month in rent out of these things." And they were, right? And then what happened was there just was too many. So it became oversaturated. So you're definitely seeing those back on the market. And so interesting fact, Keith, all you got to do is look at the pictures. And if you see bunk beds, it used to be an Airbnb. Like, you know what I mean? So that was the one. But two, let's don't forget this run that we just had put a lot of people into the rental market for the first time on the single family side too. So we never really had this many landlords on the single family side as well. And so there was all these mistakes that people made. They bought incorrectly. They had CapEx work. They bought with floating rate debt. And when rates went up, they weren't cash flowing. They wouldn't know how to manage them. So there's all this stuff that was kind of going on behind the scenes. On the apartment side of the equation, which is where I hang out mostly, I watch all this. And because my Class A buildings are competing for single family. Single family typically wins because it has a yard, has a garage. Nonetheless, I got to pay attention to it. So it's been interesting to watch. At one point, you could not find a home in the Scottsdale area under 500 grand, period, like nothing. And now, of course, those are starting to come down a little bit more. And there's some softness in the rent. So the renters have more choices. Now, why is that? There's a couple reasons. If you're a renter and you're looking for a place, I'm sure you're considering a house, but not everybody wants a house, especially if you're single, or maybe it's just you and somebody else, and maybe you don't have a pet. There's a lot of reasons that people just don't want to have a home. So you've got condos and you've got apartments and you've got homes, and then you have school districts. So people definitely want to be in certain school districts based on their children. So you have all these cross currents going on where people want to be. And so what does all that mean? What that means is there are certain markets from a rental standpoint that are doing extremely well still, both on apartments, on condos, and houses. And then there are other markets that absolutely are not. Just depends on the concentration of all those things and all those factors that are going on. The one thing that's actually disrupting a market more than anything is apartments and condos. Because, for example, Danielle just had a condo that she owned, and the condo was worth, let's say, 300 grand, but it's probably 25 years old now.
Yeah.
And there's apartments going up, a block from there, right? So her renter is said, I'd rather go over here. Brand new amenities, 9-foot ceilings, brand new fitness center,
Sure.
all this stuff. So apartments really do reach into that rental market a little bit. And so there is some spillover between that. But primarily what's going on in Phoenix is there's a lot of new construction, and not just Phoenix, this is Tucson and Greater Phoenix. There's a lot of new construction that was started when rates were low. They were started in 21, 22. Right. And because I'm a builder, it could be a year to 18 months when we're opening a project. From the time we put the shovel in the dirt, we're not even open for a good 18 months. So there's a lag period, and those started opening in 23, 24, and certainly 25. And these big projects, 200-300 unit projects, which I have several going right now, they're 1 to 2 year lease ups. So you could be looking at a 2 or 3 year lag on some of the housing that's being provided. So that's all here now. That has been good for renters. There's a couple horror stories going on, and I'll just explain. So downtown Phoenix, there was a whole bunch of apartment projects and condo projects that were built, trying to attract people to live in downtown Phoenix. Well, there's challenges for downtown Phoenix too, and we won't have to get into that. I don't particularly think that there was ever the real demand for the amount of housing. So what you've done is people build a lot of housing in concentrated areas around the stadium in West Phoenix, near the Cardinal Stadium, downtown Phoenix, right in the heart of the business district. So if you were to rent something today, it would be 4 months free on a 12-month lease.
Wow, that's about the steepest concession I've ever heard of in my life.
Yes, that's today. So all you got to do is Google it and you'll see. And the only reason that happened, Keith, is because there was too many units delivered at a short period of time, and the demand wasn't there.
Gosh.
Now go 10 miles up to Tempe, go to Chandler, go to Scottsdale, no concessions, right? So again, when you look at a market, you're going to see that it typically a lot of these concentrate in certain areas. And so there's a lot of areas in Phoenix where the consumer or the renter has an upper hand. A lot. And so they're driving their choices based on their monthly rent. All of that plays into this thing, but there's areas that are rock solid. And, that would be Scottsdale, Tempe, Chandler, Gilbert. And there's areas that are overbuilt. That would be the West Side, downtown Phoenix, the South Side. There's areas there's pockets that, are in disruption. You can kind of pick your poison, right? Like if you're a landlord, there are areas that you want to buy in, areas that you don't want to buy in. And as a renter, you have the same kind of choices. So when you blend it all together, you guys get the national news, but really it's pretty pocketed, just like it can be in any market.
Well, you bring up so many good points there. Some of these markets that have done more building than usual are in this situation where there is landlord competition for tenants. Now, nationally, we're still underbuilt. So it's interesting to talk about one of these overbuilt conditions and that competition for tenants. Like we were talking about, in general, a tenant prefers a single family home and its privacy for sure. They can't always afford that. But the apartment market and the single family rental market are somewhat interrelated because if there's so much new apartment supply, it's got the appeal of being brand new, and there might even be concessions given, like you've mentioned there, Ken, and that can make it very attractive for a potentially wannabe single-family home renter to go ahead and rent an apartment instead. So this glut of new apartment supply actually can affect the single-family rental market somewhat. And competition's really interesting. I mean, certainly in my real estate investment career, I've experienced that. The first time I ever experienced that was that I owned several doors, and they were about 25 years old, and they had garages, each one of them. A new apartment complex was built close to those, so brand new, and you had to drive by this new apartment complex, everything nice, shiny, new, painted, new parking lot, everything. A prospective tenant had to drive by that in order to get over to look to my units. That softened my rent somewhat. The one thing that saved me a bit is that my rental units were in Anchorage, Alaska. I had the garages with my units. The new apartment building didn't. They only had carports. So I did have a differentiator to help soften the blow in a rental market that became more competitive. Tell us more about the competition for tenants there in Phoenix, whether that's on the single family side or the apartment side, Ken, with concessions. And does that mean that you're altering the length of leases there in the local market? Or tell us more about how you're dealing with that competition.
It's a great question. Yeah. So I would say generally a home is going to be about $1,000 more on the average. Like if you were just to put a number on it, 3-bedroom Rambler type home with a garage and a yard is going to be maybe $3,000. That apartment, the equivalent is going to be maybe $2,000. So roughly those are kind of the numbers. But what happens if you're going to rent a house, you're definitely going to pay more money. That's for sure. And of course, depending on the area, depends on the rent. Now, what's happening in a lot of these markets, like West Phoenix, for example, where you have thousands of units being added at once, and you get this 1 month, 2 month, 3 month, and the extreme, of course, being 4 months free. If you're a renter and your rent is $2,000, but you get 3 months free, let's say, or 4, you're going to take that deal, right? Because your average rent is what, $1,200, $1,300, $1,400 a month, not $2,000. So all of a sudden, it's going to impact those single families. So what's happening right now is the apartments that got delivered in a lot of these geographic areas, these submarkets, are definitely impacting the single family rental market. Now, if you're a family and you've got kids and you got pets and you want to be in a school district, you're not even looking. You're basically just trying to find the best deal on a home. I get that. But if you have a choice, the rents are about the same, you're going to take the house.
Sure.
Period. I would, you would. So now what's happening is there's such a difference between the rental price of a home versus the rental price of a brand new apartment, that people are going to gravitate to the apartments because those landlords trying to fill those things up are scrambling and marketing to anybody and everybody and cutting whatever deals they can because they're just trying to get out of those construction loans. It's a weird market right now. And of course, there are areas, Keith, that this does not exist at all, right? Like you go into like Tempe and you're not going to have, because it doesn't have the available land, which is around the Arizona State, for example, the Arizona State University. You go into North Scottsdale, you're not going to find this because North Scottsdale doesn't like apartments. And, the homes are $1 million and up. But there are definitely pockets where this is happening. So if you're a renter and you have choices, this is a great time for you. And to be honest, it's about time because there was a seller's market and a landlord's market for a long time. And so it's just reverting back to the mean.
Let's wrap up the discussion about rents and occupancy with what's happening nationally, Ken, since in apartment buildings, you invest in multiple states there. We know, for example, that the homeownership rate recently fell from 65.7% down to 65.1%. Fewer homeowners means more renters, but that doesn't necessarily mean that they're all going to be absorbed immediately either. So talk to us about that.
There's an affordability problem, right? We haven't seen a massive adjustment with house prices. Now you have in areas, of course. I saw your recent podcast on Florida, how the price of a house is less than a car today. And
yeah,
you're right. But what's happening is there are markets that are pulling back, right? There are markets that had a bigger bubble than others, and they're pulling back. And so there's great deals in those markets. A lot of areas in Florida being one of those markets. There are other markets where you don't have that. So we are definitely seeing the same thing. And so we're having, in my opinion, it's the greatest time because you have people that I think should be able to buy a home, but interest rates seem to be holding at 6-7%. And the pricing, albeit hasn't run like it has, but it's certainly not pulling back like crazy either. It's still over 400 on the average, So if you look at the delta between what it costs to buy a home, just mortgage only, and you look at what it costs to rent, it's never been bigger. So the difference between the rent and a mortgage has never been bigger. And the other thing, Keith, that doesn't get talked a lot about are everything non-interest rate and everything non-mortgage. So let's start talking about insurance. Let's talk about property tax.
Yeah.
Let's talk about, CapEx. So there's a really good survey that bankrate.com did that said that right now, the average cost to own a home, not mortgage, is $1,500 a month. So now that's average. I'm sure there's some that's less. I'm sure some that higher. So when you take $1,500 a month to own it, plus the mortgage, you're talking about quite a bit. It's a heck of a financial commitment when you can just rent for $1,200, $1,300, $1,400, $1,500 and call it a day. You're going to move the needle twice as fast, and you're going to be able to get out of whatever financial situation you're in twice as fast when you don't have all those other costs. So what's really going on now, and the reason why you're starting to see this home ownership rate go down, and I actually make a prediction, I'm going to do it right now on your show. I think it's going to go down below 60. I think for the first time in our history, we're going to see home ownership in the 50s, 59s, which is a massive statement. But if you take a look at under Obama, it got up to 69. And then first of all, it was Clinton and before that, and then kind of ran. But then it kind of got pulled back under the Bush. And then Obama kind of took the brunt of it, when all that stuff was falling out. But it's been falling. And it's falling. Why? It's falling because people can't afford a home and they need to be able to afford a home. So we can't build affordably. The single family market is not affordable and inflation surpassing wage growth. So you have this massive shift of people, in my opinion, moving from home ownership to the rental side. And there was a time where 1% shift, Keith, was 1 million people.
1 million new renters with every 1% drop in the homeownership rate.
Was 1 million people. So imagine that. It doesn't sound like much when you go 65.7 to 65.1.
Right.
That's a lot of people when you got, 142 million people in the U.S. or a billion, right?
340, 350 million in the
300,
US.
yeah,
Yeah, about 145 million houses.
145 million. Yeah, something like that. So you start to take a look at these numbers, they're massive. So these little 1% movement is a lot of people. I think we're going to continue to see it. People need to put their stake in the ground here and get on the landlord side of this, because we're going to see a massive shift of people because they can't afford. They're going to be permanent renters for life. And it's not good. I'm not advocating it, but it just is what it is. With wage destruction, with inflation, with the affordability the way it is, people are going to be forced into the rental side of the equation. Whereas before, we were always kind of working on the fluctuations of the interest rates and the policies of the president, let's say, or whatever it was, to try to get people to be homeowners or whatever it might be. Now, we might be in some kind of a permanent state unless something really changes, because we're 4 or 5 million houses short in the U.S. as a result of the last 20 years, as you know.
I recently saw a media article that was titled "The Hidden Cost of Homeownership," and they were talking about hidden costs as things like maintenance, property taxes, property insurance, utilities. I don't know how in the heck those costs are hidden. Any prospective homeowner needs to be aware of those costs, and inflation impacts those costs, where inflation cannot impact your fixed rate principal and interest payment. There we have it, a brazen prediction from Ken that the homeownership rate will drop below 60% in this cycle, and the hordes of renters that's going to release. We're talking about the direction of rents and occupancy in both Phoenix and the nation at large. We're going to come back after the break and talk about the direction of real estate prices. You're listening to Get Rich Education. Our guest is Ken McElroy. I'm your host, Keith Weinhold. The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K, and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is GRE Real Estate Investment Coach Naresh Dissa. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with seasoned investor Ken McElroy, and he's also been one of the most recurrent guests here on the show. He's just consistently got some of the very best perspectives in the entire nation on the real estate market. And Ken, the Fred data, which pulls their numbers from Case-Shiller, it shows that the value of a mid-tier single-family home in Phoenix metro-wide has basically been flat for the last year and a half. I know your wife, Danielle, deals with single-family rentals there in Phoenix. Can you corroborate? Is that what you're seeing as far as values go there on the ground, or is it different in the submarkets that Danielle is in?
It's definitely different in the submarkets, but I would definitely concur that it is flat, Keith. Yeah. It's a very interesting time. People are used to selling things fast. Oh, I'm going to sell this, and it trades, and then they're moving it right to something else. They're not used to the markets that you and I grew up in, right? Which is, you remember the old days where we would list something and it might be on the market for 3 or 4 or 5 months? These people, these kids, these last 10 years, they have never seen anything like that. So for me, I think we're just moving back to what I would consider to be normal. I don't see a problem with flat at all. In fact, I think homes are unaffordable, and flat isn't necessarily bad. That means that both sides are kind of doing deals. That means the seller doesn't hold the cards, and it means the buyer doesn't hold the cards. And so right now is a great time to buy because if a seller's sitting on something for even a couple months, they're not used to it. There's deals to be had right now. And I think if you have the dry powder and you have the ability to move, it is a great time to buy.
You had mentioned when we were talking outside this show that your wife, Danielle, has made some interesting moves in her single family.
Yeah.
Tell us about that.
It's a fantastic move. I mean, one of the greatest, obviously I'm doing these big apartment deals. She can't relate. And she's doing these small houses, which she loves. She doesn't like debt. She likes to pay them off, and she manages them all herself. And so she bought this condo years ago, and it's worth about 300 grand. And she paid like 160 for it years ago. And the rents have dropped, per our last conversation. They used to be around 1900. Now they're around 1700. But at the same time, rents have dropped. And why would rents drop? Because there's more competition. There's new apartment buildings being built around the area. The tenants have more choices. Again, there's, rents came down a little bit. So she lost a couple $100 a month there. And the HOA hit her with costs. Our insurance went up. Our landscaping went up. So all of a sudden their HOA fees started going up. So the rents came down and the HOA costs went up.
Squeeze is on.
Yeah. So all of a sudden she's got this squeeze. And so she's looking at it. And I said, you really ought to take a look at your, what we call imputed equity. In other words, she has no debt on this thing. So she literally has, another way to say it is she has 300,000 sitting in a condo, an asset, what doesn't matter what it is. And she gets maybe, what is she making? 500 a month, maybe $6,000.
Okay.
Net cash flow a year, right? Nothing. So you take your 6,000, you divide it by your 300, and it's not a very good return, right? Okay. So she's looking at what we call imputed equity. What's your return on the equity you have? Okay. Right. So she said, I'm going to start looking at these homes that have, like you said, the garages and the yards, because again, we know that we should be able to get closer to $3,000 a month on those. So she started scouring and she found one, and it was about 450 grand. So she had to come up with another 150 grand. And so what she did was she sold the unit, the condo she had that had rising HOA and lowering rents for 300. She did a 1031 exchange into the $450,000 house. And then she had to come up with another 150, but her rent now is $3,000. And she was able to increase her cash flow by almost $1,000 more a month. So that extra 150 generated about $12,000 of net cash flow gain. And so again, she just purely looked at the math on one and did a 1031, moved it into another one. And now she's super happy. It's at a home. And as you know, in a lot of these homes, not always, but you tend to have people that don't move as much. So the guy that moved in has his son. He has him in a local school. He's young. He's probably going to be there for years. So she's probably not going to have the turnover that she would in a condo project that's really more like an apartment building. That's what she just did. And so don't forget, when prices are high, you're exiting high and buying high. When prices are in flux a little bit, like they are flat, you're going to be able to find deals. So it's a really good time to take a look at imputed equity and what's your real true return. And is there a better asset class for you to be able to move that money into? Because this is truly about managing money and maximizing your return on your own dollars. And that's a move that she just made. And she's going to be on the cruise. She'll see you. And I'm encouraging her to actually do a talk on it because there's a lot more detail to how she pulled it off. But it only took her like 4 or 5 months to do it. And it worked perfectly.
Yeah, well, congratulations there. I'm a fan of debt around here, as you know. On the summit, Danielle and I will have to have a chat, and I'll talk about why financially free beats debt free and all of that. But I would love to hear her reply. She probably has some really good, sound reasoning for that. Ken, nationally, apartment values have fallen perhaps an astounding 30%. Because the way I see it is that 3 or 4 years ago, there were tons of new apartment starts with those freakishly low mortgage rates, like you touched on. Start to completion of an apartment building can be as long as 2 years. So those starts have now become completions and they need to be leased up. So that's the glut. And that's why apartment vacancies are common in a lot of American markets today. With higher mortgage rates now, we have fewer starts, and with less new future apartment supply coming onto the market, which would have been completed in 2025 to 2027, I mean, that's something that could portend well for the future, but the current apartment glut still needs to get absorbed by tenants. So talk to us about that.
It's a great tee up for me. Okay, so I'm going to do 7 transactions this year. Now, that's all 200 plus units. So I bought 360 unit building in brand new in Las Vegas. We just closed on a 282 unit in North Scottsdale. We bought a 152 unit in Phoenix, and on and on and on and on and on. We're really busy right now because, to your point, why would we be doing that now? Here's why. Apartments are valued based on how they're operating, period. So high vacancy, high concession, flat rents, high expenses. That's all bad if you own it. It's really good if you buy it. So you want to buy at today's numbers, and that's what we're doing. We're buying at today's numbers. And we think that there's a little window that we've got through 26 to be able to acquire a bunch of apartments at these low values. To your point, they've definitely dropped. There's another case as to why, because the next piece is when the mortgage rate's high, cash flow is less. So when your mortgage payment is higher, all things being equal, your cash flow is less. So when rates went up, then people could pay less, and that drove values down. So if we can lock in today with all this disruption, so that's what we've been focused on. And it's been a very exciting year for our company. And in addition to that, to your point, which you and I have never spoken about, we just broke ground on another deal. We're just leasing up on a deal down in Tucson that we're a 300 unit building that we're just finishing. And we just broke ground on a 312 unit. And we got a couple more slated because we're trying to break ground today. And why would we break ground today? Because there's not a lot of subcontractors bidding on the stuff. So we're getting better pricing. The interest rates are high. This is true. That's not necessarily a positive. But we're breaking ground in anticipation of opening in 2 years. When all this stuff gets absorbed, we're going to be opening. And so, if we could time it today in 25, we break ground, we're going to open in 27. This stuff will be absorbed by then. The blood will be in the streets in 25 and 26 and maybe early 27. And then it's going to shift again, Keith. And people are slow to react. And so we think we're going to hit this little window at optimal time to be able to open up brand new product in 2 years.
That's great. Ken, we've been having these conversations for over a decade now.
I know.
And the way that I see it is that MC Companies, your company, was built exactly for times like this. Is that to say that you think apartment values have reached their bottom?
So I actually don't think they have yet. That's a funny comment. And here's why. Because we also went through this extend and pretend time with lenders, right? So the lenders, whoever bought something was trying to hold on to it forever. But now with this new administration and the battle with Powell's still in office for another year, who knows really what's going to happen with rates, maybe a quarter here, a quarter there, whatever. But the reality is there's no relief in sight. It doesn't appear because now we have this high vacancy, we have high expenses, and I don't think there's going to be a lot of interest rate relief. And so I think the lenders are going, you know what? We're going to start listing these. So we're starting to see just in the last few months, brokers call. I got a call the other day from a broker out of San Antonio. He said, a lender called me. They gave me 9 deals. He said the keys. They gave me the keys on 9 deals.
Gosh.
Now, and then I got another one in Dallas. It was 35% occupied. And the loan was $25 million. And the guy said they would take 14. So that's an $11 million haircut to the lender. So you're starting to see these. These are coming into my emails, right? Because they
blood
we are
kind of deal.
Yeah, it's so good. Now, I've passed on everything so far because I think the knife is still falling a little bit. And so I think we're in the first few innings of seeing these kinds of deals. And there needs to be a lot of them, right? Like they need to be everywhere. And then when they're everywhere, everything's listed and people are looking at them and there's all this interest, then I think we're going to be at the bottom, but we're darn close. I mean, we're darn close. I would say we're probably by the end of the year close. That's why if a prudent investor is getting their dry powder together now, they're meeting with their broker relationships now, they're meeting with their lender relationships now, they're putting together their LPs and they're starting to go out and look at deals now. Even if it's no. This is a time for you to build relationships and be ready to strike when you start to see stuff. This year, toward the end of the year, will be the bottom. And then I also think next year is going to be rocky for a lot of things. Then you're going to see a lot of lender write-offs.
This is really good guidance for what you, the listener, can actionably do if you are a prospective apartment building buyer. Great insight there, Ken. Ken, yes, you and I are about to be together on the Real Estate Guys Investor Summit at Sea, but there's another great event that begins at the end of next month that you put together. Tell us about that.
This is great. We have about 4,000 investors. So these are all high net worth people that invest with us. And, this is our 24th year in business. So when I meet with all of them, we used to do these investor summits. They would say, what about gold? What about silver? What about oil? What about water? What about timber? What about self-storage? What about office? What about retail? So I'm like, I'm going to create a conference where I can have everything in one spot and we can invite high net worth accredited people, be able to come there and listen to the best of the best. So no professional speakers, just people that are really doing deals. Like we have guys that are building wellness spas and hospitality. Yeah, obviously we have some single family. We got multifamily. We got a retail guy, industrial guy, commercial guy, office guy. We got a gold panel. And then we got these economists. And you probably know some of the names. So we got George Gammon coming. We got Jeff Snyder, who's unbelievable. Eurodollar University. He's coming. We got Brent Johnson, who created what's called the milkshake theory. And just Google it and you'll see it's all about the central banks. We got Jim Rickards, who wrote Currency Wars and A New Case for Gold. And we got Lawrence Lepard, who just wrote this book called The Big Print, all coming as speakers, unpaid. And they're just going to try to deliver the best value they can to the people. Because I tell you what, Keith, I don't know about you, but it's confusing. I'm reading about tariffs. I'm reading about inflation. I'm reading about unemployment. I don't know where interest rates are going. I'm feeling it at the street level, at the main street level with my apartment buildings. They're harder to manage. The expenses are going up. I try to create this environment to where people can show up and hear real things and they can make real decisions and course correct, right? And also take advantage of some other things. We're also having a manufacturing panel. And I got a whole panel just on the Trump tax bill because the opportunity zones, the bonus depreciation, all the stuff, these are things that you can do to be able to take action. So this is limitlessexpo.com. Since we're on your show, they can do Ken 10, which is a discount. The prices do go up. Obviously, they're the highest they are in July because that's when the event is. But in June, they're still lower. So I would suggest that that people go this year, especially with this new administration and everybody's like, what is going on? Hopefully it's starting to clear up some of the confusion that we all have right now and try to figure things out.
It seems like all we do know is that we don't know. Limitless how to help clear some of that up. It is July 31st to August 2nd. Tell us where it's taking place.
Yeah, it's at the Gaylord in Texas, in Dallas, Texas. It's called the Gaylord Texan. It's limitlessexpo.com. We did it last year. There'll be 2,000 people. We have 50 speakers. We have 5 stages, 50 speakers. It's a really high-end event. What I mean by that is these are real people doing real deals with real businesses, real investors. It's been fantastic. I haven't had to pay speakers because of the quality of the attendee.
That says a lot.
It's really been interesting and great. And by the way, I don't really think having big speakers to sell tickets is the way to go. I'd rather have a real quality event. And it's really interesting once you set your mind on something, because my investors and other investors show up because they do more than invest in just what we do. Like real estate, everybody wants a little piece of real estate, but they also want to know about Bitcoin. They also want to know about gold. And these are things that I'm not that proficient in. I want to hear from experts in those fields. So it's really been a great, great event.
You kind of crowdsourced the need. You listened to what your audience was asking about, and then you delivered it for them. LimitlessExpo.com. Use the discount code KEN10 to get a discount. Ken McElroy, it's been great chatting about the direction of rents and prices in the both single-family space and apartment space. It's been great having you back on the show.
Yeah, for sure, Keith. Always great, man. Good seeing you.
Yeah, Ken decidedly bullish on buying real estate, even calling it a great time to buy. He basically believes that because buyers have more power than they did 3 and 4 years ago, and they have more options. An emphatic prediction that the homeownership rate will fall below 60%. There is profundity here. I mean, the census figures on this go back to the 1960s, and the lowest it's fallen in all that time was 63%. By the way, homeownership peaked in 2004 at 69%. Apartment values have crashed about 30%, and it's probably going to get worse. So the worst isn't over, but likely will be by about the end of this year. So in Ken's opinion, most of the worst is over. I'm reading in between the lines there on that one. Hey, I hope you've been enjoying this show lately. Next week, we're going to change things up somewhat. Here recently, we've had rather prominent guests on the show, like the father of Reaganomics, David Stockman, then Russell Gray last week. This week, the owner of 10,000 Running Units, Ken McElroy. And, their perspectives and experience and influence, they are terrific, and I trust that you've learned from them. Next week, we'll have 2 GRE listeners here on the show. Regular listeners, perhaps people more like you, because you can probably relate well to their stories. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Whenever you want the best written real estate and finance info, oh, geez. Today's Experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.